says, hit the like.
Greetings and welcome to the double entry rules of bookkeeping with some financial accounting fundamentals included. We're going to take a look back in time and we're going to get to the present and looking forward to where all these bookkeeping rules touch us day to day. That said, before we do get started, just remind everyone this is strictly for the educational entertainment purposes of this YouTube channel and broadcast, not to be used, misconstrued, or abused for anything legal, lawful, public, private, personal, financial, business, tax, or otherwise, so please don't do this at home. That said, let's get started. So we're going to be going over the double entry rules of bookkeeping and the application thereof, from the dual effect of a transaction, hence double entry, to the T accounts, the trial balance, journals, and the financial statements. So, look at our learning outcomes here. What you should be able to do after this presentation. I have it condensed. We should be able to get through this within an hour, but look at this. We'll be able to record the elements, place assets, liabilities, and equity into the accounting equation. We'll apply the relationship and use each link between the elements, as each transaction has its dual effect, hence double entry. Post and prove. We'll post transactions to a T account and prepare a simple trial balance. We'll practice in there, and then we'll journalize. We'll recognize, big words here, recognize transactions using formal journal entries, and report. We'll prepare just a simple financial statements from those records. Let's get started. All right, starting with the foundations, the accounting and the dual effect. Every transaction touches at least two items, and the equation never stops balancing. So it's a dynamic equation. And before we continue any further, just remind everyone we should have the talking chat enabled here. So if you have any questions, comments, or clarifications, just put them in the chat there, and it should read it back.
The tribe says, hit the like.
Yes, indeed. So there it is. Let's continue. So there's four ways a transaction moves the equation. So our equation is the assets or equity or capital plus liabilities. So a relationship exists between the elements of the financial statements expressed in the accounting equation. So because of that relationship, each transaction or event has a dual effect. It will, time and again, have one of these four effects. So remember, assets are a combination of your equities and your liabilities, or your capital and the liabilities. So you got to think of equity or the capital is the things you're able to buy, the liability or the things you had to borrow, and the assets are the combination of those two. Those are moved through income and expenses, etc. But those are the main accounts that we look at for the accounting equation. So within that equation, let's look at these terms. One, we have if an asset rises, another asset goes down. So an asset increases while another asset decreases. An example given here is you buy a vehicle for cash. So it comes from a cash account and it goes into another asset. So it goes out of one account, the cash, the bank account, to buy the vehicle, and then it goes into your, I guess you would call it your current assets, or to the where your vehicle fleet would be. We'll look at that later in detail. Another scenario here is where the assets go up and liability or equity also goes up. So an asset increases and a liability or equity increases. Example given here is you buy on credit. So in this case here, you've increased liabilities, and from doing that, you're able to use it to purchase assets. And here also, asset going down, liability or equity goes down. So an asset decreases, and then a liability or equity decreases. Example here is pay a payable. So there's something you have to pay, a liability, and by paying it from your asset, say a bank account, the asset is reduced, but you also reduce your liability because you paid a bill that was in this account here. So again, by moving it here from the asset account to one of these liability accounts or equity account, whatever you have to pay back. Say you use the equity from the owner's capital, and that asset needs to be returned. This is where all the movement eventually ends. Now we have liability going up. That means another liability or equity goes down. So a liability increases while another liability or equity decreases. So let's continue on from there since there's no example. Before we go further, just to bring us back with a little memory device here, because we could get lost in the sauce here as much of this double entry bookkeeping isn't typically taught. So we have the dead click method up here, and this is a good memory device for knowing which accounts increase on which sides of the T balance here, T account. So we have debit always means the left, credit always means the right. CR stands for credit, and of course DR stands for debit, but that's just how it is. It's been that way for a long time, and just have to be aware of that part of it. All right, just one moment here. Just making sure we're even online here. I haven't seen any activity here in the chat. And I want to check online here. Here, we'll edit this part out here. Okay, so the main concept of the dead click method or memory device here is to know which side a transaction lives on here, so to speak. So for instance, these are the accounts where you have a normal balance on the debit side. So it's a normal debit balance, meaning that
Not a Taliath says that seems cliche.
yeah, well, it's just where they get it from. But this is actually from I got this little memory device from a accounting book for legal paralegals, I think. So these are people that definitely didn't want to major in mathematics of any nature. So you have to give them some kind of little mnemonic device that involves letters. All right, so on the normal debit balance, so the accounts where you normally are putting the balance on the debit side, the left side, meaning most of the activity, you're increasing it here on the left side. Expenses. So if you're increasing expenses, it goes on this side. If you had increasing assets, like money going in the bank account, on the debit side. And drawings. So you're drawing from an account. That would be on the debit side. Every time you make a drawing, the addition to it would be over here. So the debit to increase, credit to decrease. So on your drawings account, whenever you're making a drawing from it, it would come from the credit side, but if you're adding to it, put it on the debit to increase. So on the credit side, we have the click. So the D stands for debit again, E for expenses, A for assets, and D for drawings. Now on the credit side, the click, we have C for credit, of course. The L is for the liabilities. I is for income, and C is for capital. So as we see from our accounting equation, it's really just the assets here. These are things that are the part of the company's part of their assets. Let's just leave it with the double entry bookkeeping terms. And it's addition of the liabilities plus the capital. These can be increased, again.
Fiddlemaker J. Nunj says, may I please ask you about the 5RH column? Big business denies there is such a thing. You and I know it exists. Basically, how do you feel about it?
The 5RH column, not too sure what you mean by that, right? Maybe it's just misspelled there. But right now we're just looking at the two columns of the T accounts here. So I just want to be clear that these accounts here, when you're going to increase them, when you want to see the amount in that account increase, you would put the amount to increase on the credit side, the right side. On the accounts where you want to increase them, that are expense accounts, assets, or drawings, where you want to add to those accounts, you would put it on the debit side. So income here, being the one that's not part of that accounting equation directly, is a flow of funds into this account here, right? And it's a liability until it's realized and it moves over into one of these accounts, or of course it would end up just over here in the capital. So again, these are considered liabilities because in the end, everything ends up in the capital, and the capital has to go back to the owner of the business in the end of things. So it's ultimately a liability to the business, the owner's capital, the owner's equity, the shareholder's equity. All right, so the first step is always which category does the transaction go into? Dead click does the rest. So you just got to think about the transaction.
Fiddleminger J9J says the fifth column, excuse me, I'm sorry, literally going blind here. Don't let my first wife beat your face in with a glass vase.
Yeah, don't do that. The fifth column, I'm not too sure what that means though, but perhaps we'll come into it through this presentation here. All right, because we're going to be digging deep. I just want to bring this little mnemonic device back here for us so that we can be aware of it as we go along here, because it's going to be expected to be, of course, the assets go on the debit side. Okay, so here's our conceptual framework. We have, as we saw here before the word, recognition, and we have derecognition. So recognition is the increase. An element item, the increase, is recognized only when it meets the definition of the element and the information is useful to a user of the financial statements. Wow, so it ties all the way to the financial statements or the output. Typical element items recognized: delivery vehicle, trade receivable, and bank. These are some element items. Trade payable, loan, revenue, cost of sales. So we have for this presentation the assets, liabilities, and any resulting income, expenses, and equity changes are assumed both relevant and faithfully represented. So we're not going to discuss fraud elements. Everyone's very honest, as they should be, in this presentation in the hypothetical scenarios. And then we also have derecognition. This is the decrease. Think about this. These words seem to mean other things, and this is really the essence of accounting and bookkeeping. Here are the terms. We have recognitions, the increase; derecognition, the decrease. Derecognition records the reduction of assets and liabilities previously recognized. So they're on there and they're being derecognized. In this presentation, it's limited to, of course, the asset bank, like the cash was used. The asset trade receivable, the receivable was paid. The liability trade payable, loan or something, and it was paid. So that would be the derecognition, paid it off. The decrease in these assets and liabilities is recognized on the day on which cash flows. This is interesting. Regardless of, I guess, where the entry is, they are recognized. So terminology here is very important. Book entries, recognition. All right. On the account now, let's look at this. Each item has its own record, and that's called the account. For every element item, there's a separate record in which the effect of transactions accumulates. So these are the books. That record is the account. Each carries a unique number that references its element. So let's go from that T column we were looking at there with a debit on the left and credit on the right. The account began as a T. With computers, it shifted to a statement column format, as I think you're referring to there with the fifth column. But the T format remains the teaching tool used here. There's a list of accounts. The full table of items plus numbers is a list of accounts, a chart of accounts. So we have a list of accounts. This is an important item here to think about. And we have built to balance because each item sits on a defined side of the equation, the accounting equation. Posting follows fixed debit credit rules. So these are the rules we're going over here. There's also the contra asset accounts: accumulated depreciation, accumulated amortization, and the allowance for doubtful debts. Each sits on the credit side of an asset account, but are kept separate to preserve information. Look at that. The bank account can switch between favorable asset and overdraft liability. So the bank account can switch. So we have contra asset accounts. Interesting there. So the bank account, when there's overdraft, it becomes a liability, but when it's not overdraft, it's an asset. Contra asset accounts. Interesting. Accumulated depreciation. Boy, that's a lot to depreciate to become a liability. Then again, I guess you could say some assets might do that on day one, but I digress. All right, let's look at this list of accounts. Now we're just going to hammer through this so you get a feel for what we're looking at. These are just asset accounts. So let's look at some of the, we have current assets and non-current assets, like sometimes called fixed assets for some of these things, like land and buildings. But look at this. We have asset items, but accumulated depreciation, that's like a contra asset, isn't it? And machinery, the cost and the price, the accumulation, depreciation, that, oh, geez. We have vehicles, same with that. So we have different accounts for the depreciation of these assets. Look at this. So there's the so-called contra accounts. It seems like, but not really, because I think the bank accounts, we're going to find out as we go through here. But all of these here, we see here where the furniture and equipment have accumulated depreciation accounts as well. So you have 5.1, 5.2 for the assets here, and that's how you know that they're related. Same 6162. Look at this, trademarks, cost price, and accumulate amortization of trademarks. Wow. Right of use cost and accumulated depreciation of the right of use. Whew. So look how all these things can be calculated to take full advantage of how that accounting equation balances for whatever purposes it needs to meet there. And look at some of these here, trade inventories. That's just straight up asset because that's your inventory. I mean, there's no, hopefully you don't have depreciation of your inventory. Trade receivables. You have allowance for doubtful debts. Allowance, wow. And office supplies on hand. So this is, oh, geez, you keep a little money there for the doubtful debts. Prepaid insurance as an asset. Prepaid rent as an asset. Deposit for water and electricity. Those are all deposits here. It looks like 23. Office supplies on hand. So you can see here, rent deposit paid, term deposit, all these things that have already been met, obligations met, are assets. So income receivable, asset. Bank favorable balance. See, this is when it has a favorable balance. So it's not, I shouldn't say these are contra accounts. These are just different types. They're accumulated depreciation. They're still asset accounts. But this one here is with a favorable balance. And same with value added tax if you're in across the pond there in Europe. Hence that spelling. Okay, now let's look at the other side of the equation with the equity or the capital and the liabilities. So equity is the owner's stake or the shareholder's stake in the company, what's been invested into it of their own capital, so to speak. And of course, where all the fruits of all the labor end up. And the liabilities, what's borrowed to be able to make things happen. All right, so we have here equity items, share capital, retained earnings, interesting there, and dividends. All these are liabilities. Are on the equity side. But again, these are increased by going on the credit side. Then we have the non-current liability items, such as a mortgage bond. So non-current meaning that they're more long-term, so to speak. Bank loan, lease liability, and supplier's loan. So we have all these different accounts here, all separate accounts. The only one we have here is retained earnings and the dividends, both in the same category here. Then we have also the trade for the liabilities. On this side here, we have the trade payables. We have rent expense payable. All these are payables. Audit fees payable, rent deposit received. So when you receive this is where that can balance out. Where you had as an asset, now the liability and the asset will cancel out there. I'm not sure what this one is here. Pension fund contributions, medical aid, Again, value-added tax. When it's unfavorable in a bank overdraft balance, see, we have a different account number here. This is A30, and let's look what it was for the favorable balance. Come on. There we go. It's still A30. Okay, so there it is, a true contra account. The same number, but it would switch from being an asset item, depending if it has a favorable balance, and if it has an unfavorable balance, bam, now it's a liability. So it's a contra account in that nature, in that respect there. All right. So, all right, we made it through that chart here. Let's look at the income and expenses now. We have income items. Again, these are all on that credit side. They live on the credit balance. This is where they all come in on the credit side, the right side. You have things like revenue, rent income, interest income, term deposit, interest income, favorable bank, so you're not negative interest, I guess, and profit on sale of non-current assets. So like let's say you made a profit on land or something like that. These are all considered income. On this one here, we have rent income and income interest term deposit. So that's from their deposits, perhaps, on the rental units. There it is. All right, now let's look at the expenses. Cost of sales, salaries, water, electricity, telephone, insurance, loss on sale of non-current assets. So if you sold the land for less than you paid for it, there's where the loss appears in this account. You see this? Very simple. They all have their own different numbers here. Every single account does until we get down to the depreciation on vehicles. 20.3, the amortization here, trademarks, which is also there. So these are things where interest expense, that is on 30. This looks like a part of the bank series there, and audit fees. So as we see here, depreciation with vehicles, all these in the 20 series, but with a U as a prefix, so we know it's an expense. They don't want to use E because it's already used. So I don't know why U is used for expenses, but that's how it is. Nothing in accounting is intuitive. Okay, let's look at the format of an account now. Let's get back to our T account. As I said, this is just for the teaching tool here. We're looking at the simplest form of it, which involves the two columns here. We have a debit side, a credit side. Left side's debit, right side's credit. Each side carries columns. We're going to have things like date, detail of contra account, the reference number here, and the amount. So these are the columns we're going to see in this setup here on each side of this T account here. So we have the debit, which is a verb, is to record an amount on the left side of the account. So you get that? That's very simple. What's a debit? It's a verb. It means to record an amount on the left side of the account. And when we say credit, that means it's a verb again. It means to credit an amount on the right side of the account. A contra account is the other account named opposite each entry. It reveals the dual effect. And the NR column here, a reference number that traces each entry back to its source.
James Allen Cooper, 2779 says, money of accounts, money of exchange.
Indeed. Excellent. And greetings to you. It's been a while. So yes, this is the, just look at the anatomy of a T account, because this is the foundation of where the rest of these columns, pages, accounts, everything come from. But this is the way we balance it out. All right, let's move on here. So we have double entry rules here, deduced from an equation that must always balance, and was first written down in 1494. Did a nice presentation on Luca Pacioli, and it should be in this playlist here. But that was the birth of double entry bookkeeping. Pacioli applied Arabic algebra to the records of trading houses. When we say trading houses, these were the merchants of Venice. The double entry system he described was so robust that it still forms the basis on which every effect of every transaction and event is incorporated into an entity's records today. And that was in 1494 was the years the rules were written down in the Summa de Arithmetica. Of course, he was a prominent mathematician. I think the first one actually had a portrait made of him uh, over this book here. All right, two enduring consequences. For each debit amount, there's a corresponding credit amount. And the accounting equation remains in balance after every entry. So even today, accounts are still called ledger accounts. The ledger, now living in electronic form. So we'd go and deep dive into Pacioli, friend of Michelangelo's. He traveling friar. He went undercover as a Franciscan monk so he could get through war-torn areas, saying, "I'm come in peace," so we could spread the knowledge that eventually it's pretty much in place to this day. So let's look at this accounting equation here. Elaborated, then rearranged, so all is positive. So here's our elaborated form. So we gave you the simple form earlier. Assets equals liabilities plus share capital plus retained earnings, so that account, plus income minus expenses minus dividends. So move expenses and dividends to the left, so only positive amounts remain on each side. So see how this works? On the left side, we have assets, expenses, dividends. These items increase on the debit, the left side of their account. So we get to the dead click. We see it right there, dividends or drawings. So debit D, DE, well, they have it the other way here, DEAD for dead click. Click is on the right side, credit. We have liabilities, share capital, plus retained earnings. They had this one here for the elaborated version, plus income. So for click, we have the credit C plus liabilities LI and capital C. But we also have retained earnings in here. So retained earnings usually would end up in a capital account, but as this elaborated version, this is how things work in the real world. These items increase on the credit right side of their accounts. So it seems strange, but this is the basis of how things keep arranged, is that they keep the specific accounts increase their balance on a particular side depending on the nature of the account. So assets, expenses, dividends on the left, liabilities, share capital, share, you could say it's a shareholder stake or owner's stake in the business, retained earnings plus income. And income's the variable, expenses are the variable. These are what change the amounts, these two accounts here. So this is a general overlook. Let's move along here. And let's look at the rules for the double entry system. Each transaction affects at least two accounts, one or more debited, one or more credited for an equal total. So this is the essence of it right here. Double entry, two accounts. Left side items, we saw again, assets, expenses, dividends. Increase on the debit side. The account of the item is debited. The other account concerned is credited. So on the right side items, we have liabilities, income, share capital. Oh, geez. In the opening here, this is the, geez. It'll come to me in a minute. Anyways, on the right side items, we increase the credit. The amount of the item is credited. The other account concerned is debited. So our dual entry, equal total. Again, on the assets, expenses, dividends, if there's a decrease, there's a credit. The account is credited when we decrease. We take something out of the assets. We take something of dividends or we reduce expenses. Decrease of an expense or dividend seldom occurs. As I just said here, to reduce expenses is kind of counterintuitive to a business functioning. And dividends, I mean, unless you're stealing them, yeah, they seldom occur. So again, we're talking about in the normal course of business here, you'd only see a decrease on the asset side, like a bank account, as you would pay from the bank account. But dividends as they stand, no. All right. Now, on the right side here, we have a decrease on the credit for these accounts. The account is debited, the other account is credited. So a decrease of share capital or income seldom occurs. So again, income is usually something that continually increases. This is why it's income, not outcome. And because of that, it seldom or should never really decrease, so to speak. It should never be entered in on the left side. And same with share capital. The end result of the business is to accumulate the share capital for what it's anything that's left over at the end, and then of course from there you could structure out the value of the shares and everything else that goes from there. But I don't think shareholders are into it to see the share capital reduce over time. I think that they expect to see capital increase. All right, now let's look at the basis of the double entry system here. So any asset account increases on the debit side, decreases credit. Any expense account, same thing. Any dividend account, so we're making dividends from those shares, increases on the debit, decreases on the credit, paid out. So any liability account, it decreases on the debit side. So liabilities, loans, you get a loan, it goes on the credit side. You are given credit. Any income account, it decreases on the debit side, increases on the credit. You got income, so it goes on the credit side. From here, you can move it over to another account. Share capital, same thing, decreases on the debit, increases in the credit. So you might be making purchases from the share capital account. You would decrease it to move it over to another account and purchase assets perhaps. So the left side items, assets, expenses, dividends, grow on the debit side. Right side items, liabilities, income, share capital, grow on the credit side. So we got to go over this over and over because it's difficult to really internalize unless you're done this a few times and gone through the books. And it is a stretch for most people, but it definitely is affecting anyone that deals with the commerce system or anything in commercial transactions, which is everything contractual these days, including just going to the store and buying a bottle of milk. All right, so temporary accounts close to retain earnings. So let's look at income, expense, and dividend accounts as temporary, nominal. At the end of each reporting period, they are closed off to retained earnings, and a fresh set is opened. So this is interesting here. The income accounts, expense, and dividends are temporary, nominal. And at the end of each reporting period, they are closed off to retained earnings, and a fresh set is opened. So think about that. Reporting periods. So this is another aspect to understand is the reporting period. How can you make any calculations unless you know the period of reporting? Because again, then the accounts are cleared out. A fresh account basically is opened. So on this, now you'll have things like the carryover balances and such, but we're not talking about that at this point. These are temporary accounts. They close to the retained earnings account we saw there. So income, the credit side of retained earnings. Expenses goes to the debit side of retained earnings. And dividends go to the debit side of retained earnings. So these all go on the retained earnings account on their proper side. So the income goes on the credit. Expenses, things you spent money on, go on the debit side. And the same with dividends, ones that are all right, so our profit or loss for the period. Income is greater than expenses. The entity yielded a profit for the period. So here's the first time we even see this word profit. If income is less than expenses, the entity yielded a loss for the period. For the period. So when you think about for the period profit, it's now how much of a profit, how much of a loss of each period, and how much are offset. We get that seasonality here and such. So, and also think about this is that if you're a farmer growing crops and there's a certain season, then there's going to be a certain period where you're not yielding profit. But then, of course, the profit, when it does come season, more than makes up for that, hopefully. Now let's look at some practical applications with effects 1 and 2 and work transaction type. So here's effect 1. Increases an asset and decreases another asset. So going through here, we get to kind of see how literally here with the vehicle purchase where the rubber meets the roads. And just remind everyone, for those that stick around here, we do have a very special treat at the end of this presentation, and we're almost there. So if you stick around, you'll be very pleased with that part. Now, here's our example transaction. You purchase a vehicle, a delivery vehicle for cash. The account's debited, vehicles, that's your asset. The account credited was the bank. So you have a bank account. Of course, whenever you put money in the bank account, it goes on the debit side. But when you're paying from that bank account, the amount you had to pay was from the credit side. So the credit side used to pay for the vehicle. Vehicle is an asset. The amount of the vehicle goes in the asset account for that amount. Credit, same amount on the bank. Okay. Next is the purchase trade inventories for cash. So we get some trade inventories. That goes into that account. So your inventories, your trade inventories, that's the name of the account. It goes on the debit side, of course, and same with the bank. You had to pay for it. It's credited on the bank account. That's going to reduce it. Bank account increases on the debit side, similar to the asset account. They're both asset accounts. I meant the inventory account here. Next, we have invest surplus funds in a call term deposit. So the account's called the call term deposit account, and same thing. That money came from the bank account, put it in the credit. That means money came out. It seems counterintuitive that when you're taking money out of the account, you call it a credit because they switch it on the consumers with a whole different terminology and using a cash method instead of this double entry bookkeeping method. So the terminologies don't line up. Next is effect 2. The increases an asset and increases a liability or equity. So let's look at some of these here. Here's an example transaction. This time we purchased a vehicle on credit, our delivery vehicle. So the account's debited. Again, same thing. The vehicle goes into the vehicle account. It increases. It's an asset. It goes on the left side, a debit. However, this time we're crediting a different account. We do a payable, a supplier's loan. That's on the credit side because we increase that account, and it's a liability account this time. So we're increasing this one here. This is on the payables here. Let's see here. On this one here, we have a purchase trade inventories on credit. So here's our trade inventories, same kind of thing. This time we did on credit. But what account? We're going to credit this time on the trade payable account. So that means that we put it on the credit side. We're going to eventually have to zero it out. We're going to pay it off. That would go on the debit side for that account. So again, with the bank account, the money was there. We're removing from our own account. Here, we're creating a liability where there's going to be a trade payable that we're going to have to debit to that account. So here's kind of the nature where we say we purchase trade inventories on credit because we added credit on the trade payable account. All right, and then we get to shareholder deposits, cash into the entity. So we took the shareholder deposits and we cash it into the entity. So the account's debited, that cash came in the bank, and we moved it over to the share capital. So we moved the cash, deposits cash into the entity. So we went to the bank, the shareholders, we said we're going to put money into the company. Deposit the money in the bank, that has to come in as the debit because it ends up in the share capital, and that goes in as a credit. We can now draw from that from the debit side later if we need it. Cash sale of trade inventories, sale price. So we have bank and account credited, again, revenue. So we had a cash sale of these inventories here. So this is the price. We the money goes in, debit side, but we have to pay to the revenue. And the credit sale of trade inventories and the sales price. Same thing, trade receivables is the account debited because we have a credit sale of trade inventories. We did a credit sale, and the amount credited is revenue. So again, that revenue's been increased there. This is like income, right? And rent income received on cash, in cash this time. That went right into the bank account, debited. And then, of course, rent income was, well, this would have come in here first, and then we would have had it over here. Oh, we received it in cash. Okay, there it is. And then it would be credited over here to the rent income. Gets a little confusing the way the money comes in. You need to be very specific, and that's what these little notes are for in this column here. As you see here, we're now going to look at this effects 3 and 4 work types here. We have effect 3 that decreases an asset and decreases a liability or equity. So here's pay an amount due to a trade payable. So we do the trade payable account is debited. We increase that. The amount credited, we took it out of the bank account to balance that out. We have pay the installment on a loan. So the account debited was loan. That's a liability. We debited it. It reduced it. And credited from the bank, we also reduced the bank account to pay it. Pay the shareholder dividends. We have dividends account. Again, this is to pay that. The amount credited is the bank. Came out of the bank into the dividends account here. This is the amount debited. Dividends are increased on the debit. Wait a second here. All right, we'll pay them. Okay, we'll pay an expense, the wages in cash. So the wages here and then paid in cash. Amount credited, it comes out of the bank account and goes into here, this wages here, and delivery sold. Inventories at cost, perpetual, so cost of sales, and of course trade inventories are the ones credited. Let's look at effect 4 here. This increases a liability and decreases another or equity, another liability or equity. So this one increases a liability and decreases another. So incur an expense. Okay, so repairs on credit. So the account debited, we had to pay for repairs, so we put the amount we had to pay because we have to increase the amount on that account of repairs. That's increasing a liability. And then account credited would also be payable. So that's an extra liability we're going to have to pay. So obtain a water or electricity service on credit. So the account, of course, water, electricity, that's increased. And of course, the credit payable. And pay a payable using a bank overdraft. Whew, yikes. So payable is the account debited because we increased on there, and the account credited is the bank, the overdraft. So we saw there because of the standing it's in, but hopefully never has to occur for any of our businesses. So let's get to the worked examples here. For part 3, we have AC Ltd and AA Ltd from transactions to financial statements. So hold on for this ride here. All right, we got through the dry part. This one's fun. Recording the dual effect directly in T accounts. So AC Ltd commenced activities on the 2nd of January 2017, perpetual inventory system. During January, here's our dates here, the 2nd, 5th, 25th, and 30th. On the 2nd, shareholder transfers property into the company, $1,200,000 with, that was $200,000 in land and $1 million in buildings. Generous shareholders. Next, same date, shareholder opens a current account and deposits $1,800,000. Then on the 5th, furniture and equipment of $225,000 was received from payable X, or payable K, payable on the 30th of January. Okay, so we got some credit here on liability. 25th of January, trade inventories of $20,000 received from payable L, payable on the 24th of February. More liabilities. And trade inventories, which will go into assets. And the 30th January is the amount due to payable K. That's $225,000, but that's paid. All right, now how do we record all of these transactions? These are events that need to be recorded properly. Let's see how to do it for those financial statements. Here it is. Posting to the T account. So first of all, we have asset 1, land, January 2nd. Detail. It came from share capital, the amount $200,000 added into this account. We have money for the land here, right? And that was $200,000. Or I'm sorry, this is land, $200,000 worth of land. So this is debited to the land account, and it came from the share capital. And we have same thing, A21, the buildings. This is $1 million, same date. Now we have here asset 5.1, the furniture and equipment. On the 5th, here's our details. Payable K, $225,000. So this is under a furniture and equipment. And of course, this is increased because this is our furniture that just got here. And then we have trade inventories of $20,000. And this is on payable L is the detail here. And of course, we're increasing this into our inventories. So reading a posting. The asset bank increased on transaction 2. So bank is debited. The share capital increased, so share capital is credited. Apply this, identify the items to identify the elements, increase or decrease, apply the rule routine every time. So if that makes any sense in reading the posting, you can kind of see here how this happened though. Now let's look at the bank balances and the equity and payables. So we have on the 2nd, we have bank. Let's look at this bank detail now. Share capital of $1,800,000. That was that nice donation there. And we had on the 1st of February a balance due of $1,500,000. No, we haven't got there yet. So on the 30th of January, we have a credit entered in on this bank account here. There's an asset account. That means we reduce it by $225,000. So on 31st of January, we had a balance of $1,575,000. So coming over here, we had on February 1st, started out with $1,800,000, and we had the balance is $1,575,000 because we had that payable there. So now let's move over here to the share capital. So on all these were on the 2nd. We got the land, the buildings, and that nice generous deposit to the bank. So a total of $3 million. Next we had K1, the payable K. So now we're into our liabilities here. So on the let's see here. On the 30th, we paid them back out of the bank. $225,000 was debited. Or I'm sorry, this is reduced from the bank account, was debited on the payable account because on the 5th of January, before that, it had increased the $225,000 for the furniture and equipment that was delivered. So the difficult part of looking at this, see we have a January 30th here and a 5th of January over here. So it's important to keep track of the columns. And again, it's just adding up the columns and then you come down to your final balance here. And of course with assets, remember the balance lives on this side here. So this is our final balance was $1,575,000. On this one here, these were both paid off, so they both balanced out. There's nothing left here. Yeah, because the 30th we paid it. Next, the share capital. We did that. And then finally, the payable L. This is another liability account. But we haven't paid him yet. So it's sitting here, $20,000 on the credit side because this account's still there. It's not zeroed out yet. So determining the accounts balance. Here's our technique. 1, total the debit column and the credit column for the month. So we total those up. 2, balance equals a larger total minus a smaller total. Okay, right? Balance CF under the smaller side on the last day of the month. Then total each column on the same line and rule it off. Here, 410,000. Then carry the balance down, the balance BD, under the larger total on the day one of the next month. So let's go back and look at this, see if it was done right. Carry forward. Yep. All right. So looks like it has been. So again, right, balance CF under the smaller side on the last day and carry the balance down, balance BD under the larger total of day one. So let's look at this here under trade inventories. So on February 1st, the balance down, this is the carry down balance here, was 220,000. Fourth, bank, 60,000. On the 26th, payable K, the credit, 130,000. So we have a total of 410,000. And over here on the credit side, we had the cost of sales was 96,000. And February 20th, the balance CF here, of course, is under the smaller side, was 314,000. So what we got here is 410,000. We add these up. So even though these are cost of sales and the balance and such, you can see here where this all comes together. So our balance down here, whatever, for the 1st of March now is, see here, under the larger total for the next month. So this is where we took the 314,000 over to here. So this is at the end of that month. Our numbers add up and we add them up, but this is our balance down, to carry the balance down number. So pretty confusing, but if you sit here and do it a few times, it'll make more sense. So let's do that. Let's look at the remaining accounts balanced at 28th of February. So end of the month. Let's look at the bank. Okay, on the 1st of February, the balance down was 800,000. Receivable A, we paid him 140,000. That's a total of, let's see, receivable A. No, we received money on this. So sales here, 140,000. So the total amount in the bank here is 940,000 on this side for everything we've increased it. Now we start to take our decreases here. So we have the trade inventory, 60,000. Payable K, we paid that bill, 24,000. So we have here the balance from on the end of 28th here will be 856,000. So same thing here. From the 940,000 minus all these things here would leave us with the 856,000. And there it is. So on March 1st, we're starting our balance down with 856,000. And of course, we add up, we can see here 940,000, 940,000. These all even out. So by bringing in that balance there, this allows us to balance out the whole equation here. All right, we know nothing's left behind. Now let's look at receivable A. On the 1st of February, we have the balance down here, 204,000. We had some revenue, so we add 192, we got 396,000. Now we had the bank, 140,000 had to be paid over to there. So let's see here. This is on the receivable. Okay. So we took some of that money from the receivables and we put it into our bank account. So we have here 256,000 for the CF balance here. That was from left over from here. And we add that all up, so we have the 396. We have the 396 here. So our balance down $256,000. Of course, you can sit here at the end of it and know that you add up, I've spent this much, and we brought in this much, and you could play around with that to see and double check and triple check, which accountants used to have to do, but computers pretty much do it all for you and will quickly let you know, especially in this spreadsheet kind of format. Now let's look at the payable K. So this is where we're paying. So we have February 25th, the bank, 24,000 on the debit side here. So this is where we decrease it by paying 24,000 from the bank account. And on 28th, that's our carry forward here, 190,000. All right, so on the credit side, the balance down here was $84,000. On the 26th of February, have trade inventory here under the payable here. We got on credit 130,000. So total 214,000. Everything there we subtract, and we get 190,000, just as we did over here. So this is our balance down is 190,000. That's what we owe here on payable K. So this is see here. Now we have revenue. So we have on the 28th we had a balance of $192,000, and on the 24th we had a receivable A, and it seems we paid him 192,000. So there's the there it is. Let's see, revenue, or no, that's revenue coming in. So receivable A gave us 192,000, and our balance here will be 192,000 in our revenue account because that's all that came in. All right, boy, this stuff can really get your eyes glossy looking at it for a while. So let's look at what that balance means and reconstructing the transaction. The meaning of the balances: the balance BD 1st of February, the net effect carried down from 31st of January. The example was $800,000 favorable in the bank, 204,000 owed by receivable A, 84,000 owed to payable K. Then we have the balance CF for the 28th of February, the same net position carried into March, $856,000 bank, $256,000 receivable, $190,000 payable. Now let's look at why it works. The balance summarizes the net effect of all transactions on that account. Because accounts are balanced monthly, the figure carried forward on the last day equals the figure brought down on the first day of the next month. So we have the carry forward and the brought down. Now we have transactions reconstructed from the entries. So let's look at this here chronologically. 4th of February, reconstructed transaction. Purchased trade inventories of $60,000 for cash. Received the same day. 22nd of February, received $140,000 from receivable A in partial settlement. So 24th of February, sold inventories on credit to receivable A for $192,000, but the cost was only $96,000. So we see you have a little profit here. 25th of February, paid $24,000 of the amount due to payable K. And 26 purchased inventories on credit from payable K for $130,000. So those are reconstructed transactions. And this list of account balances here with a trial balance. Now this is an internal document pretty much to make sure that everything was done right before you present any of the financial statements. So because every transaction is recorded duly, total debits equal total credits. So the total of all debit balances agrees with the total of all credit balances. So why prepare it? Historically, it's to test the completeness and accuracy of the dual recording. Today, with computerized systems, mainly to summarize the records at month's end. And it's a byproduct of debiting and crediting, not part of the rules themselves. As I said, this is an internal document to be used to make sure that the bookkeeper did his job right. So we have here a trial balance. We looked at land, buildings. We add all these debits up because they live on the debit side. Share capital lives on the credit side. Retained earnings, dividends. We add all these things up. And because we've been doing dual entries, and this is for a period, everything should equal up. All the credits and all the debits. We have our carry forwards and brought down and all that good stuff. So in a perfect world, it was done right the first time. If not, there's ways to find out where the defects occurred. So the trial balance to the statement of financial position on 31st of January. So here's our trial balance at the 31st of January. As you see here, we have them both balancing out, the debit side and the credit side, at $3,020,000. Now here's our statement of financial position on the 31st of January. We have the assets, the property, plant, equipment, inventories, cash, all this good stuff here. But the total assets we see here, we add it all up, is $3,020,000. So these are fixed assets and all that. Now we have equity and liabilities, share capital, retained earnings. That's our total equity right there, $3 million. And we have trade and other payables. So pretty much like the inventory here, I guess. Well, no, these are what is other payables. So this is 20,000. So total equities, 3,020,000. So these all balance out. Everything looks good on the trial balances, so we can do a statement of our financial position with confidence because they all will balance out at the end, total equities and liabilities. So we have here everything adding up just right. Yeah, and the assets there. Okay. Now let's look at the journal entries and the instruction behind every posting. So Pacquioli required transactions to be required first in a day journal before posting to the T accounts. A journal entry states which accounts to debit and credit, on what date, and with what amount, creating an audit trail from source document to ledger. So here's our format of a journal entry. We have account debited, and the amount here, and account credited, and that shows over here in the credit. Then we have a narration plus the reference to the source document. So below each entry, we also want to show its effect on the assets equals liabilities plus equity. This is educational only, not part of a real journal. Okay, so we just want to be able to show its effect by what we're putting here. So here's our equity classification column. When transaction changes equity, name the component that changed it. So was it share capital? Was it retained earnings, income, retained earnings expense, retained earnings dividends? So that's a transaction that changes equity. So income, expenses, reduce, dividends. All right. So then and now. So back in 1494, we had manual to 1970, we had manual ledgers. Accountants kept by hand on ruled pages, 500 to 800 of them. Journal entries were bound into a journal book, posted to the ledger regularly. That was, as you can see here from the thumbnail on the left side, there they are, hard at work. But then it was the end of the manual era. Then we had sub-journals appearing. The general journal expanded into cash book, sales, purchases, and salaries journals to organize posting. The general journal handled the rest. So we have general journal entries, and then we have other ones here. Then from 1970 onward were computerized systems. Subjournals effectively disappear. Transactions are captured on on-screen forms, each holding all the features of a journal. Think about your little data entry screens. But today, databases and the cloud records live in a database systems, we should say, relational database systems, often on a network or the cloud, which is just someone else's computer. Sales post in real time. So we have things like just-in-time inventory that relies on point of sales postings. Posting and balancing are programmatic, so errors are unlikely. Well, yeah, I guess the computers really can't be caught stealing, so In a way, there's less problems with the programmatic sense, and you can see why. Also, when you look at the whole thing of keeping manual ledgers, uh, to audit this stuff takes a lot of work, and clever bookkeepers can definitely make the job of the auditor difficult. With computer systems, it's rather straightforward, especially if they're standardized systems. It makes it easy to audit. With a database in the cloud, it's even more frightening because these are recorded live on someone else's computer. All right, so let's look at journalizing the January transactions. January 2nd, we had land and buildings, and that goes into share capital. So 200,000 plus 1 million. So that's what the generous shareholders donated. And on the second, the bank, we had also share capital credit here with $1,800,000. So they went to the bank, they deposited to the bank, debits the bank, credit the share capital. January 5th, furniture and equipment debited into that asset, put into the credit of the payable account. So now we owe money that was bought on credit, $225,000. And on trade inventories on January 25th, payable L, another one on credit, $20,000. And finally, payable K, bank gets credited. We paid him $225,000. This guy here. So we paid him off full. So now his account should be down to nothing. So narrations matter. Each entry carries a reason. Example given, J1. So I was skipping the little journal entry numbers here. So each line, journal 1, journal 2, journal 3, journal 4, and journal 5. So each entry carries a reason. Example given is journal 1, recognize share capital contribution by shareholder. Journal 5, de-recognize payable K due to settlement of debt. Yeah, see, that would have that in there. The reference number NR column links the entry to the relevant account or journal number. So there it is. Yeah, there should definitely be a lot of columns to these things because narrations matter. Let's look at the full cycle to February 2017. Oh, that's not a 1. Okay. Should be a 1 instead of a dot. But here's the accounts. Land, we saw this stuff. 200,000. Furniture and equipment. Trade inventories. So here's what we get in the bank. So these are all debited. We add these up here. We have share capital of 3 million and payable. So 3,020,000 adds up 3,020,000. And we get our February transactions. I don't think I need to read through all these. If you want, I could, but I don't think we need to. This is just part of that narrative. But you can see how it's done. Each date, inventories, 60,000 purchase COD, cash on delivery. Sold inventories on credit to receivable A at $96,000. The cost was $48,000. So you see, is all these are detailed in each transaction. So depending on which journal you're looking in. Okay, so here we go. Journals 1 and 2. So we have journals 1 through 6. We have J1 here is deposit, water, electric, and the bank is credited because we reduced from our bank account to pay them $20,000 that deposit. And journal 2 here on the 5th of February, we have trade inventory. So we have all these journal entries here. And again, the effect on the equation here. This is pretty much for our uses here. You wouldn't necessarily need to put it in like this, but this is so you could see how each amount we put in here, for instance, the cost of sales, debited, right? This count increased. The trade inventories. So this is an asset account. We decreased it for that cost of sales here. And we have negative 48,000. And that's our assets reduced equals here the E minus 48,000. So our equity minus $48,000, which is the expense. It's a liability. So we're just flipping this equation around here. No, I'm sorry, you plus the negative 48,000, isn't it? All right. So it gets a little confusing when you look at it like this, but it's just to try to explain how it has an effect on the accounting equation, each transaction. So the narrative should somehow carry it. You wouldn't do it like this. So here's our narrations. J1's a recoverable deposit. So that's what we let them know here. J2 is inventories plus liability. There it is, inventories plus liabilities. And J3 is cash purchases. We have here trade inventories from the bank, cash, makes sense. J4 is credit sale, income plus receivable. And J5 is the cost of inventory sold. You see here, cost of sales. Pretty expensive. And J6 is the settle payable to L. So payable L, bank, 20,000 minus 20,000. So there it is. Everything balances out in the way we see it here. Nothing's left, and any of the details we have included in here. Now we're on to, all right, so there we go. Let's look at the equation summary here. So again, we have the bank revenue, same thing here. It all balances. Total debits equals total credits, 720,000. The net movement, assets increased by 378,000. The liabilities increased by 133,000. The equity increased by 245,000. So looking at it like this, the assets equals liabilities plus equity. And those liabilities, again, are the loans, the payables, things like that. And they landed up as assets. So we're not a charity organization. Everything has to go somewhere. So the two busiest accounts balance. We have bank account and the trade inventories. So we can see how this works. This one here, the bank, we only deposited here on the 1st of February, 1,575,000. That was our the brought down balance here. So on the 28th of February, so not much activity here as far as going in. We started out with that million, and we made some revenue on the last day, and we also got some share capital on the last day. So adding all these together, we get $1,839,000. We increased that bank account during the month. However, we didn't increase it by that much. This is what we ended with of all the from the start to all the debits. Then with the credits, on the 1st we had to pay that deposit for water and electricity. We had to get some trade inventory. We had to do the payable from the bank. We had to pay that 20,000. We had to pay salaries and wages, and we had to pay dividends, 12,000. All that came out of our bank account. That all adds up to 1,712,000. So there we go. Balance down here is 1,712,000, and again here 1,712,000. Let's see here. Yep, there it is. And there it is, 1,839,000. So on the trade inventories, we had same thing here. Details with the balance brought down with 20,000. Payable M, 145,000. That good stuff. And the bank, 60,000. We put in there. So I'm sorry. This is Yep. So there we go. And then we use that to get the cost of sales here was 48,000. That reduced our trade inventories. The cost of sales also on the 28th, 32,000. So the balance here, the carry forward is $145,000. And there it is there. Again, adding these all up, we get to the 225, so we know they all balance. So let's get our trial balance here. See, the dual recognition guarantees the agreement. The total debit balances $353,513,000 equal the total credit balances. So we add up all the balances from each account at the end of the month, and they shall balance out, and they do. Now let's look at profit and loss changes in equity 2 months. So profit and loss for statements, we can see how this works. You get revenue, cost of sales, gross profit, administrative expenses, profit before tax, all this good stuff here. And we see how it goes. We get share capital, return earnings, and total. So profit for the period, 57,000, 12,000 in dividends taken out here. So you can see how this works here. We're going to move ahead. And a statement of financial position. We have non-current assets, current assets. Add those up, we have our total assets. We have equity and liabilities on this side. These live, of course, on the credit side, so fittingly we have them over here on the right side. Nonetheless, the equity accounts here with the share capital, retained earnings, total equity $3,245,000, and their current liabilities, the trade and other payables, $153,000. We add these all up according to the accounting equation. $3,398,000. So on the balance sheet, it still balances. The assets equal equity plus liabilities equals $398,000, but now reports far more than the equity itself, hence the modern name. The PP includes the $20,000 recoverable deposit. Where's that on there? All right, well, we'll take their word for it. All right, let's get the key takeaways and the rules in one breath if I can do it. So we have a dual effect. Every transaction touches at least two accounts. Total debits always equals total credits. There's the sides of the equation. Assets, expenses, dividends rise on the debit side. Liabilities, income, share capital rise on the credit side, the dead click. And the account and its balance. Each item has an account. Balancing summarizes its net position and feeds the trial balance. So the balancing summarizes net positions and feeds the trial balance, which is still internal, and the journal ledger statements. Journalize with narration. Post to T accounts. List the balances, then build profit and loss, all those financial statements and statement of financial position. Good stuff. Now it takes us to the best part, our double entry quiz. So for those of you that have made it this far, congratulations. Now we get to the best part. All right, question 1. The bakery's new delivery van. Tandy's Bakery Limited buys a $180,000 delivery van from Motor Company on credit, payable in 60 days. No cash changes hands yet. Which of the four dual effects does this transaction illustrate? Is it A, an asset increases while another asset decreases? Is it A, all right, he got this on credit. An asset increases and a liability increases? C, an asset decreases and a liability decreases? Or D, a liability increases while equity decreases? Anyone want to take a try at question 1? Put in the number, followed by the letter of your choice.
Original Gangsta 794 says E.
All right, we got a D for, I think that's for number 1. Definitely want to put in, I guess we have a lot of people here today, but you can still put in the number, and that way if you want to change your answer.
Not a Taliath says 1D.
All right, so we got 1D, a liability increases while equity decreases. So this is it. Buying the van on credit, payable in 60 days. No cash. All right, let's move on to question 2. Paying the shareholder a dividend. On February 28th, AC Limited pays its shareholder a $12,000 dividend by electronic fund transfer. Applying the double entry rules exactly as records require. The correct entry is A, debit the bank account $12,000, credit dividends $12,000. So he paid shareholders dividends by EFT, so electronic fund transfer from his bank. So is it A, debit bank $12,000, credit dividends $12,000? Is it B, debit dividends $12,000, credit bank $12,000? Is it C, debit retained earnings $12,000, credit bank $12,000? Or is it D, debit dividends $12,000 and credit share capital $12,000? So they're paying their shareholders a $12,000 dividend, and it's coming by E.
Not a Taliath says 2C.
All right, we got a 2C debited.
Original Gangsta 794 says
All right, so we got a good variety here. So A is debit bank 12,000 and credit dividends 12,000. So if we think for the give a hint here, the dead click, the D could also be dividends as well as drawings. So think about this: if you're paying shareholders 12,000 dividend by EFT, I'll leave it with that. You can always change your answer by putting in the number of the question followed by the changed letter. That said, we'll move on to question 3. Balancing the inventories account. A, trade inventories account has debit entries totaling, or I'm sorry, one of these things is called double A LTD and a thing. Okay, so a trade inventories account has debit entries totaling $410,000 and credit entries before balancing of $96,000. When it is balanced at month end, what is the balance? And on which side is the balanced CF carry forward written? It's a tricky one here. So the entries totaling 410,000 and credit entries before balancing of 96,000. So, which side of the balance is the balance carry forward written? There's a trade inventories account. 314,000. A is 314,000 and balance CF is written on the debit side. Is it 314,000 balance CF is written on the credit side? Is it 506,000? Adding them together here, and balance CF is written on the credit side? Or is it 96,000 and balance CF is written on the debit side? Tricky one here. Anyone wants to take a chance at this one? All right, going once, going twice. This is a tricky one. All right, let's get on to question 4. The books must be error free. AC Ltd's
Not a Taliath says 3F.
All right. Okay. 3A. So 314,000 and balance CF is written on the debit side. Gotcha. All right. Final question here. AC Ltd's computerized trial balance at 28th of February shows total debits of $3,513,000 equal to total credits of $3,513,000. The junior bookkeeper concludes the books must therefore be free of errors. Junior, what is the best response to Junior? Correct. Equal totals prove every transaction was recorded completely and correctly. B, the agreement is essentially a byproduct of dual recording. It summarizes the records but does not prove completeness or accuracy. C, equal totals confirm the company earned a profit for the period. Or D, the trial balance is a compulsory step in the double entry rules, so the books are validated. All right, we got an easy one here. Computer balance.
Not a Taliath says 4B.
All right, we got B. So the agreement is essentially a byproduct. It summarizes the records but does not prove completeness. So the agreement in the trial in this trial balance. Indeed. Anyone else wants to take a try at question 4? We're going to move on to the answer key. All right, for question 1. with Tandy's Bakery buys the delivery van on credit. Correct answer was B. An asset increases and a liability increases. And why? Is because effect 2. The asset vehicles increased, debited. The liability payable increases, credit. Because that's a liability that's on the credit side to increase. Because the van is bought on credit, no cash leaves, so no asset decreases. So that's the key right there. So B is the correct answer for number 1. And you have the reason here. The asset vehicles increases, but the liability also increases. So an asset increases and a liability increases. All right, on to question 2. On February 20th of February, AC Limited pays its shareholder, lucky guy, a $12,000 dividend by EFT. Applying the double entry rules, correct entry is B. The debit dividends 12,000. You credit the bank 12,000. We took 12,000 out of the bank, so to pay him his dividends, so we would debit the dividends. Again, that's over there on the liability. Well, this particular one is here. It sits on the left side. Wait a second here. I'm sorry. Yeah, you're increasing the debit on the dividend side, but you would credit the bank 12,000. The dividends sit on the left side. The assets equal expenses plus dividends. So the dividends. Wait a second. Oh yeah, okay, yeah. Expenses plus dividends here. So the dividends account increases on the debit side. The asset bank decreases and is credited. So the retained earnings is only touched later when the nominal accounts are closed off. Okay, so there it is. So the debit dividends 12,000 because they pay shareholder 12,000 dividend, but by ETF. So the 12,000 is credited for that ETF, and it goes over to debit on to the dividends here. However, so these are both moving on that same side. I see here. But the retained earnings is only touched later when the nominal accounts are closed off. So there it is. All right, let's get to the final questions here. Question 3. The trade inventory account has debit entries totaling 410,000. The credit has before balancing 96. When it's balanced, what is the balance and on which side is the balance carry forward written? Correct answer is 314,000. The account and the carry forward is written on the credit side. Let's see why. And that's question 3. Balance the larger total minus smaller total equals 410,000 minus 96 equals 314,000. So there it is. And that's a debit balance. So the balance carry forward is entered under the smaller credit side. So both columns total 410,000. It then carries down as a balance brought down on the debit side on the day 1 of the next month. So there it is. And the balance is written on the credit side, the smaller side. So there it is. Harder to see without the diagram on 3 here, but yeah, it was 3B. Who would have thought? All right, now we're on to the final question here. Number 4, AC Ltd's computer trial balance on the 20th of February shows total debits of $3,513,000 equal to the total credits. A junior bookkeeper concludes the books must therefore be free of errors. Correct answer, of course, is B. The agreement is essentially a byproduct of our dual recording, as we've seen before. It just summarizes the records but does not prove completeness. Indeed. So there it is. And that's because every transaction is posted with equal debits and credits. The totals still agree, even if a whole transaction is omitted or amounts are posted to the wrong same-sided account. Today, the trial balance mainly summarizes the records at month end. It is not part of the rules themselves, and it's typically just an internal document. All right, well, this has been a long presentation here. I thank all of you that stuck with it to the end here. Definitely salute to you for sticking with it. This is not intuitive stuff to the least. It was never meant for the masses to fully understand, as you can see here, is originally with rooms of bookkeepers moved on to the computerized systems where now everything is done through a cloud, but using these same principles, using these same organizations and the same way of moving transactions across accounts. And of course, the books, the ultimate documentation of how business is conducted. And with that, just remember that accounting is the language of business, and to really understand how these things function and how commerce really moves money, it's important to understand the bookkeeping functions and the accounting. We want to hold people accountable. We need to learn accounting. With that said, salute to you all for being here, and I hope to see you all on the next one. Peace out.
The tribe says, hit the like.